All right, everyone ready for today's deep dive?
Always excited to dive in.
Well, get ready because we're tackling charts of accounts.
Ooh, that's a good one.
It might sound a little, dry at first,
Yeah, I can see that.
but trust me, this is way more interesting than you might think.
Definitely agree with you there.
Just imagine, okay, trying to keep track of all the money for a whole company,
Oh, wow.
every single dollar coming in and going out.
That's a lot of money.
It is, and that's where this thing called a chart of accounts comes in.
I see. So it's for keeping it all organized.
Exactly. It's like a secret decoder ring for a business's finances.
Love that analogy.
You sent us some great articles and resources on this.
Looking forward to digging into them.
Me too. And we're going to try to break it all down, make it easy to understand.
Always a good goal.
So, big question number one. What exactly as a chart of accounts?
Well, let's jump right in.
Please.
A chart of accounts, or COA for short, it's basically the backbone of a company's entire financial system.
Backbone, huh?
Yeah, think of it as this super detailed index.
An index, like in a book.
Kind of, but instead of topics, it's every single financial account the company uses.
So every time money moves in or out, there's an account for it.
Exactly. It's all tracked there.
Wow. So is it just this massive, overwhelming list then?
It's definitely more than just a list.
Okay, good.
It's structured, organized. Think of it like a really good filing system.
Okay, I like that. A filing system, but for money.
Exactly. Every dollar that goes in or out of the business.
So it's not just one big folder labeled money.
Nope. It's broken down into smaller categories.
Oh, okay. So, like, what kinds of categories?
Well, one of the articles you sent had a great analogy about personal finances.
Oh, yeah, I remember that one.
Like we have separate checking and savings accounts.
Right, one for daily spending, the other for saving up.
Exactly. And a COA does kind of the same thing for businesses.
No, I get it. So instead of checking and savings.
You might have separate accounts for things like revenue, expenses, assets, liability.
Whoa, okay, lots of new words there.
We'll break them down, don't worry.
Okay, good. But I see the basic idea now.
Yeah, it's all about keeping things organized so you can see where the money's coming from, where it's going.
Makes sense. That seems super important for, actually understanding the company's finances.
Absolutely. It's all about getting that clear picture of their financial health.
It's like their financial roadmap then.
Perfect way to put it.
Okay, so we've got the big idea, but what about these main categories on this roadmap? What are they?
So a COA, it typically follows the same structure you'd see on financial statements.
Financial statements, got it.
The main categories are, let's see, assets, liabilities, equity, revenues, and expenses.
All right, I've heard those terms before, but...
But how do they actually break down within the COA, right?
Exactly.
Well, let's take assets as an example.
Okay.
Under that big category, you might have subcategories, like current assets.
Current assets meaning...
Things the company expects to, convert to cash within a year.
Oh.
And then within current assets, even more specific accounts, like cash itself, accounts receivable, inventory.
Accounts receivable, that's the money owed to the company, right?
You got to see how it gets more and more detailed.
Yeah, that's really helpful. It's like zooming in on a map or something.
I like that. You start with the big picture, then get more granular as you go.
Makes sense. Okay, so we've got main categories, subcategories, tons of detail.
It's a whole system.
It is. But I got to ask about something I saw in one of the articles.
Shoot.
It talked about operating and non-operating revenues and expenses.
Ah, yes, that's a key distinction.
It is.
Very much so. It's all about where the money is coming from and going to.
Okay, but what's the difference?
So operating revenues and expenses, those are directly tied to the company's core business activities.
Their main business, basically.
Exactly. So if a company makes and sells bicycles,
Bicycles. All right.
the money they earn from selling those bikes, that's operating revenue.
Oh, exactly.
And the costs of making the bikes, like the materials, that's operating expenses.
Okay, so it's all the money coming in and going out because of their, main business operations.
Precise.
Got it. So then what about non-operating?
Well, those are the revenues and expenses that aren't directly tied to their core business.
So for our bike company, does that mean they're selling something else besides bikes?
Not necessarily. It could be something like, let's say they have an old company van they decide to sell.
Okay, so they're not in the van selling business, but...
But they make a profit from selling that van. That would be non-operating revenue.
Oh, I see. So it's kind of like extra income or expenses that pop up outside the normal business.
That's a good way to think about it.
But why is it so important to keep those separate?
That's where it gets interesting.
Oh.
Because this distinction, it helps you understand the full picture of their financial performance.
Okay, how so?
Well, you can see how well their core business is actually doing.
Right, separate from any one-time things.
Exactly. And you can also identify any significant gains or losses from those one-off activities.
So it's not just about the overall profit, it's about where that profit came from.
Precisely. Let's say a company reports high profits, but you look closer and see it mostly came from selling off assets, not their actual business.
Oh, that's a good point. That could be a sign that something's not quite right.
Exactly. It's about looking beyond the surface.
Wow. So the COA, it's not just helpful for the company itself.
Right.
It's also for anyone trying to, analyze their financial health from the outside.
Absolutely. It's a window into their operations.
This is making me think of investing. Like if you're considering investing in a company.
Knowing how to analyze their COA can be incredibly valuable.
I bet. Okay, so this is seriously cool stuff. I'm starting to see how powerful this can be.
It really is.
But I have to ask, a company's activities can change over time, right? What happens to the COA then?
That's a great question, and it brings us to a really important point.
Let's hear it.
A COA, it's not just a static document. It needs to evolve along with the business.
Oh, so it changes over time.
It has to. As a company grows and changes, so do its financial activities.
So how do they keep the COA up to date without making it a total mess?
That's where having a well-structured COA from the start really pays off.
Okay, so it's got to be flexible from the beginning.
Exactly. It needs to accommodate changes without losing its integrity.
Kind of like building a house with the possibility of adding on later.
Perfect analogy. You don't have to tear down the whole structure just to add a room.
I see. So building a solid COA is all about laying a strong foundation that can adapt as needed.
You got it.
That makes sense, but starting from scratch must be daunting, right?
It can be, especially for businesses that are just starting out.
Right, like where do you even begin with something like this?
Well, there's some key steps to guide the process. It all starts with understanding the specific needs of the business.
Okay, so it's not one size fits all.
Definitely not. The size and complexity of a COA. It often reflects the size and complexity of the company itself.
That makes sense. Like a huge multinational corporation probably needs a way more elaborate COA than a small local bakery.
Exactly. The bakery might only need a few dozen accounts to track everything.
While the corporation might have thousands.
It's all about scale and what the business actually needs to track.
So once you've figured out the scale, what's next? How do you actually start building this thing?
Well, after you've identified the key financial activities, then you move on to establishing those account categories.
Account categories, right? Like grouping related accounts together?
Exactly, based on their purpose and nature, like those broad categories we talked about earlier. Assets, liabilities, equity, revenue, and expenses.
Okay, and then you break those down further.
We
right?
got it.
Oh.
You create subcategories and individual accounts within those larger buckets. And then, of course, you need to assign unique codes to each account. Yeah, for easy tracking and retrieval, it's all about creating a system that's comprehensive but also easy to navigate.
Wow. Okay, I'm starting to see how much detail and thought goes into this. It's like creating a financial fingerprint for a company.
That's a great way to put it.
But is there like an official way to do all of this? Are there rules companies have to follow?
You bet. That's where GAAP comes in. Generally accepted accounting principles.
GAAP, right. I've heard that before, but never really understood what it meant.
Well, think of it as the accounting rule book.
The rule book, okay.
It makes sure everyone's playing by the same rules.
Right.
Like a referee in the financial world.
Okay, so how does GAAP specifically relate to the COA?
Well, it provides guidance on how to classify and define all those financial accounts, how to recognize and measure transactions, even what valuation methods to use.
So GAAP basically sets the standards for how financial information should be recorded and reported.
Exactly.
So a company's COA needs to follow GAAP.
A COA, designed in accordance with GAAP, ensures that a company's financial statements are credible, transparent, and comparable to other companies. It's like a seal of approval saying, hey, you can trust our numbers because we're following the rules.
That makes sense. And speaking of rules, I remember seeing something about FASB in one of the articles. What is that exactly?
Oh, FASB, the Financial Accounting Standards Board, they're the rule makers.
Wait, so if GAAP is the rule book, what does FASB do?
They make sure the rule book is always up to date. Think of them as the referees who are constantly reviewing the game, making sure the rules are still fair and relevant.
Okay, I see. They're like the rule-making committee for accounting.
You got it. They're constantly evaluating existing standards and issuing new pronouncements to keep up with the ever-evolving world of business and accounting.
So FASB makes sure the rules stay current, and companies use those rules to create their COA and prepare their financial statements.
Right, it's all about checks and balances to ensure consistency and reliability.
And that's crucial for investors and anyone else who relies on those financial statements.
Absolutely. It's about creating a level playing field and making sure everyone's speaking the same financial language.
This is all making so much more sense now. We've talked about how a COA needs to be adaptable, able to change with the business, but one of the articles also talked about the importance of maintaining consistency. Can you explain that a bit more?
Sure. While a COA needs to be flexible, consistency is key when it comes to tracking and analyzing financial data over time. If the structure is constantly changing, it's hard to compare performance across different periods.
Yeah, it'd be like comparing apples to oranges.
Exactly. And you wouldn't want to be constantly shifting categories in your budgeting app. It would make tracking your spending a nightmare.
So a consistent COA makes it easier to analyze financial trends and make decisions about the future.
Right. And it simplifies the audit process, since auditors need to review those financial records and assess compliance.
So consistency is key for both internal analysis and external audits.
You got it. It shows that a company is committed to accurate and reliable financial reporting.
It builds trust and can have a huge impact on their reputation.
Absolutely.
I'm starting to see how understanding a COA is like having X-ray vision into a company's finances.
It really is.
And we've covered so much ground here already, from the basic definition to the structure and creation process, and now gap and consistency.
It's amazing how much thought goes into this seemingly simple idea of tracking money, right?
It really is. And I have to admit, I thought this deep dive might be a bit dry, but I was so wrong.
I'm glad you're finding it interesting. It's one of those things that often gets overlooked, but it's so important. A solid COA is crucial for any business, big or small.
Without it, it's really hard to track, analyze, and understand a company's financial performance.
Exactly.
And that understanding can be valuable for so many people, not just accountants and financial experts.
You're right. It can be valuable for anyone who's trying to understand a company's financial story.
Okay, so we've talked about how the COA needs to be adaptable, but one of the articles also mentioned the importance of maintaining consistency.
Ah.
What does that mean exactly? Why is it important?
So, while the COA needs to be flexible, consistency is key when it comes to tracking and analyzing financial data over time.
I can see that, yeah.
Think about it. If the structure of the COA is constantly changing, how can you accurately compare the financial performance from one period to another?
That's true. You'd be comparing apples and oranges.
Exactly. And it's the same for businesses. A consistent COA makes it much easier to analyze financial trends, spot potential issues early on, make more informed decisions about the future.
That makes a lot of sense, but it also sounds like it could be a headache to maintain that consistency.
It can be, but the benefits definitely outweigh the challenges.
So consistency is key for internal analysis, but what about external audits?
Oh, absolutely. A consistent COA also makes life a lot easier for auditors. The people who have to review the financial records and make sure everything is compliant.
Right, because they need to be able to follow the money trail easily.
Exactly. A consistent COA shows that the company's committed to accurate and reliable financial reporting, and that can have a huge impact on investor confidence and the company's overall reputation.
So it's not just about numbers, it's about trust and transparency.
Absolutely.
Okay, I think we've covered a lot of ground here.
We have, from the basic definition of a COA to its structure creation process, the importance of gap, consistency.
It's pretty amazing how much thought goes into this seemingly simple idea of tracking money.
It really is. And it just highlights how crucial a well-structured COA is for the financial health and stability of any business, whether it's big or small.
It's the foundation for all of their financial decisions. I have to say, I came into this deep dive thinking it might be a bit dry.
I hear that a lot.
But I was so wrong. It's been fascinating to see how all of these pieces fit together and how much power this tool holds for understanding a company's financial story.
Me too. It's one of those things that's often overlooked or taken for granted, but truly is the foundation of a company's financial management.
Without a solid COA, it's incredibly difficult to track, analyze, and ultimately understand a company's performance.
Couldn't agree more.
And that understanding can be valuable for so many people, not just accountants and financial experts.
Yeah, it's like we said before.
It's like having that secret decoder ring for understanding a company's finances.
Exactly.
So now that we've cracked the code of COAs, I want to leave you with a little challenge.
Oh, I love a good challenge.
Think about how this knowledge could apply to your own personal finances.
That's a great idea.
Right. We talk about budgeting and tracking our spending, but how many of us actually have a system that's as organized and insightful as a COA?
That's an interesting question.
What if you created your own personal chart of accounts?
Whoa, our own personal COA.
You could categorize your spending, track your income, and get a much clearer picture of your financial habits.
Instead of just lumping everything into groceries or entertainment, you could have subcategories,
Exactly.
like eating out, groceries for home, movies, concerts.
It's like taking those jumbled receipts and turning them into a clear financial roadmap.
I love that.
And speaking of roadmaps, think about how understanding COAs can help you navigate the world of investing.
Oh, absolutely. If you're looking at a potential investment, being able to analyze their COA can give you a whole new level of understanding.
It's not just about looking at their bottom line.
Exactly. You want to understand how they got there.
What are their main revenue streams? Are they relying too heavily on non-operating income? Do their expenses seem out of control?
All questions you can start to answer by digging into their COA
It's like peeking behind the curtain.
and seeing the inner workings of their financial engine.
So whether you're managing your personal finances or evaluating a potential investment, understanding COAs can be a total game changer.
It's such a powerful tool.
We've given you the key, now go unlock those financial mysteries.
I love it. This has been a great deep dive.
It really has.
Always a pleasure to explore these topics and make them a little less intimidating.
Couldn't agree more. And a huge thank you to you, our listener, for sending in such great resources.
We love diving deep into the things you're curious about, so keep those questions coming.
And as always, be sure to check out the show notes for links to all the resources we mentioned today.
Until next time.
Keep diving deep.